Hello, everybody, and welcome to this week's podcast. My name is Jay Gragnani. Joining me this week is John Lewis, and appreciate everybody taking the time to join us for our weekly discussion. This week, we have a great topic of the technical leaders indexes. The technical leaders indexes are something that are very near and dear to our hearts here at Dorsey Wright, as we've been publishing and developing the technical leaders family of indexes for a number of years now. And what we wanted to do is have a discussion as we are here in the midst of a quarterly rebalance amongst those indexes, and have a discussion about those indexes, what we've seen take place inside of the changes across specifically the major U.S. equity indexes there specifically, but also the changes that we've seen just in general, John, across the markets. 2021 has been a year that we've seen a lot of changes, not only on the surface, but underneath the surface as well, as we've seen a lot of changes just amongst the leadership trends in the market this year.
Yeah, Jay, it's been a really interesting first quarter. There's been, as you said, a lot of changes under the surface, and that really kind of comes on the heels of a very prolonged outperformance by kind of one specific area, and that's that large cap growth and technology area. So that has really reversed itself, and we've seen energy move to the top of the ranks for a while, and financials is moving up, and we've seen that total flip between large cap and small cap, and all these small cap indexes has moved up to the top of the Dolly ranking. So within this kind of 3-month period during the first quarter, what we've seen is a total change in the overall character of the market. And when we rebalance these indexes, they are very market-based. They're very adaptive to changes, and we're seeing a ton of changes this go around, and really kind of more than I can remember in recent memory.
Yeah, and it's interesting you mentioned that, and because it's been years where large cap and specifically growth has really been the dominant area of the market for going on the better part of the past 5 or 6 years now. And for the first time, one relationship that we monitor is kind of growth versus value. And for the first time in about 4 years, that relative strength relationship has shifted over towards, in general, value being favored over growth. And that is just something, those trends, they can last for many years. And so we'll see how long this trend lasts. But underneath the surface, certainly there has been this rotation happening. What we haven't seen change really or falter, though, is the strength of U.S. equities. I mean, U.S. equities, when we think about our relative strength ranking, our Dolly tool, which stands for Dynamic Asset Level Investing, U.S. equities moved back up to the top spot back in August of last year. It entered 2020 ranked number 1, fell out of favor in the midst of the COVID collapse, if you will. And then by August of 2020, moved back up to that number 1 spot. And ever since then has just continued to improve, continued to get stronger. International equities as well, just the general equity markets have continued to perform well, bumping up against new all-time highs here through the first few months of 2021. And so that risk-on appetite for investors has continued through the course of the year as we move now into the second quarter of 2021. So with that said, I mean, just the big trends I think we've seen that we've touched on is, the value over growth phenomenon. You mentioned energy and financials as sectors have moved up. As a matter of fact, energy and financials within Dolly have been the most improved areas of the market, while healthcare and technology have been the areas that have lost the most ground from a ranking perspective within Dolly. So that kind of value trade has been seen within the sector rankings. The other big trend you mentioned earlier is the small cap over large cap has continued to play out itself. So those are kind of the big trends. As we look, though, specifically relating to the technical leaders indexes, as you mentioned, you've seen a lot of changes this quarter, and they're adaptive. And you mentioned the first time in a while. I mean, John, these indexes go back to 2007 was the first launch of the technical leaders indexes back in 2007. So this is not something that's just over a couple of years, and even in the teeth of the 2008 market. the changes that we're seeing now are of historic proportion in terms of just amount of changes that we're seeing. So, what are kind of the big trends within those technical leaders indexes that we're seeing unfold?
Yeah, so I think the big trends within those technical leaders index really do reflect what we just talked about in terms of the overall market. So heading into the first quarter, so the end of 2020, in large cap, we were really heavily weighted toward technology. That is a huge weight that's coming down, right? So we're going from somewhere in the mid 40s down into the mid 20s. So that's a really big move for kind of a 1 quarter type of period. And what we're seeing pick up are things, things like energy. We're seeing that kind of come in. We're seeing some financials come in. The big move, though, is technology, that reduced weight. Consumer cyclicals is also picking up as well. And we've seen cyclicals pick up with the vaccinations kind of ramping up and return to work kind of on the horizon. We've seen consumer type of stocks do a lot better. And that, again, is reflected in that large cap technical leaders index. On the small cap side, the biggest weight coming out is from healthcare. And you touched on that as well. Healthcare has really dropped down in the ranks. And kind of at the beginning of the quarter, we saw large cap healthcare fall off. That hadn't been doing as well, but there were some pockets of strength in the small cap area, especially in that biotech area. That's really pulled back. We're seeing a lot of small cap biotech exposure come out of that index and be kind of reallocated to other areas that are picking up steam. So the way these indexes work, they're very kind of sensitive to these big changes in the market. We've had a lot of these changes this quarter, and we're seeing those definitely reflected in both the large cap and small cap technical leaders indexes.
That's interesting. I mean, specifically as it relates to technology, I mean, you think about it going from overweight within the portfolios, 40 some odd percent to, basically back down to market weight, if you will, as it relates to the S&P 500. The S&P 500 is about 26 or so percent, 27% allocated towards technology. So, basically technology overweight down to market weight. It'll be interesting to see over the course of the next quarter how that fares. But one of the biggest differences, and I think one of the biggest advantages when you think about the technical leaders indexes and how they're constructed, is that they are adaptive. The only way that, say, the S&P 500 is going to reduce its technology exposure is just the market depreciation of technology or appreciation of other areas versus, say, a technical leaders index, which, if we think about just the main technical leaders index, it starts with a very large inventory and is designed to identify a narrow basket of stocks that is showing the best momentum or best relative strength over time. So, John, can you spend in just a couple of minutes talking about just kind of what that looks like? What's the starting inventory universe for the technical leaders index specifically? And then how many stocks ultimately at the end of the day are selected to go into that index?
What we're trying to do in the technical leaders indexes, as you mentioned, is take a very broad universe and select a subset of securities that are the best momentum or relative strength names in those indexes. So for kind of broad, just a broad way to think about it, we try to take around the top decile of these universes and we'll own that kind of top decile of our ranks. We hold them for 3 months, and we also then go and weight them by the momentum score. So stocks with better momentum get a higher weight in the index, and that just kind of tilts that index a little bit more towards that momentum factor and makes it even more of a factor index rather than market cap weighting or equal cap weighting. We think that factor weight is something that really helps over long periods of time. So on a large cap index, for example, that universe is about 950 to 1,000 stocks. We're taking the top 100. On a small cap basis, the universe is around 2,000 stocks, and we're taking 200 out of there. So that kind of top decile is what we've identified over the years is really where those best momentum names are. And we go through once a quarter, reconstitute, rebalance that index and refresh it make sure that we've got the best momentum names in there 4 times a year.
And we talked a lot about the sector movements, technology specifically, seeing a pretty big reduction in there. One of the things too that I think is unique about the technical leaders indexes is they're not sector constrained, so they can really go where they need to go based on where the strength is in the market. And it's really the sector weightings. They're a byproduct of the momentum or the relative strength of the individual securities at the end of the day, versus a byproduct of pegging it to a specific benchmark.
Yeah, that's right. It's truly go anywhere from a sector perspective. And I think from a relative strength and momentum standpoint, that's very advantageous, because there are times when there's very kind of concentrated momentum or relative outperformance, and you really need to overweight the index there. And we do have a very systematic and disciplined way to cut back on that exposure. We just talked in large cap, for example, about technology. That can get cut out of the strategy very quickly. And what is left is things in that area that are still performing. We've seen technology, for example, in that large cap index. A lot of the mega cap tech names have come out, and it's more kind of the mid cap type of exposure. So you get that going on in the indexes as well. So that adaptability, we think, is very key over time, and it will change as the market changes. So that's how these momentum processes are designed to work. And it takes, a few quarters sometimes if there's massive changes in there, but we're really kind of seeing that work right now when we did the rebalance this quarter.
Yeah, and to that point too, is you don't have to own any sector. And so if there's stocks and sectors that just aren't working. I mean, I remember years back, energy specifically, there was zero energy exposure in some of those indexes at points in time, just because there were not any energy stocks that were performing well or showing up on those relative strengths. So there is this unconstrained nature to those indexes. And so in total, we talked, John, today about the U.S. Indexes, that kind of the U.S. large mid and as well as the small cap indexes. In total, there are 14 indexes that we publish or calculate based on the technical leaders ranking that span from U.S. exposure to individual sector exposure to international markets, as well as individual foreign markets specific to certain countries. And so the process, though, is very similar. It's the same systematic and discipline as we go about putting those indexes together. And the quarterly rebalance, that is something that over time has been shown to provide the adaptability needed in those indexes. And can you spend just a couple minutes, John, talking about why quarterly, why versus another time frame, say daily or weekly or monthly or something like that?
Yeah, so quarterly, we've set these indexes up to rebalance quarterly, and we've done a few things in the index to make sure that quarterly time frame is really advantageous. So you can set these things up a number of different ways, but what we realized is that the way we have this set up, what we're looking for is very kind of long-term outperformance from these securities, and we also know that there's a lot of short-term mean reversion in stocks. And so what you wind up with, if you rebalance these indexes too frequently, you wind up trading on a lot of the short-term noise. And you have a stock, for example, that has a good 3 to 6 months, and then it needs a breather, and it just underperforms the market a little bit, and that winds up coming out of the index, and then you need to put it back in the next month. And that is just kind of a normal course of how stocks behave. They don't just go straight up. They go up, they back, they fill. And so what we're looking at by doing a quarterly rebalance is essentially giving all of these stocks some room to run. And it's the same engine that drives all of these technical leaders indexes. We haven't optimized it for certain universes or anything like that. If you think about it like a car, right? We have this one engine and drivetrain, and then we're just kind of putting different bodies on top of it, and those are the different universes. And so it's very, very adaptable, and it really serves us well to do it quarterly so that we can account for a lot of that short-term mean reversion that you see in all kinds of equities, whether they're small cap, large cap, international, domestic, that sort of thing.
That's great. Well, that's, obviously we're in the midst of a lot of changes, not only in the markets, just a lot of change, economically and the likes, but, there's a lot of changes going on underneath the surface of these technical leaders indexes. So it's always, interesting to stay on top of and see how they have changed from quarter to quarter. Right now, as we're kind of getting into the beginning of the second quarter of 2021, we've certainly seen a lot of changes, and we'll continue to monitor those and see how those trends play out in the market as we move through the second quarter of 2021. And we'll look towards the end of the second quarter, and they're evaluated, the technical leaders indexes specifically evaluated calendar end each quarter. So 4 times a year, those portfolios have the ability to make those changes, and not only rotating into the stocks that are showing the best momentum, but also, and probably equally as important, is getting out of those names that are not performing well and are showing relative underperformance versus whatever their specific benchmark or inventory happens to be. So with that said, we appreciate everybody joining us this week for the discussion on the technical leaders indexes specifically, and just general big macro trends that we have seen so far unfold through the first quarter of 2021. We look forward to discussion this time at the end of the second quarter, as well as we see and look to see how prevailing market trends may or may not impact the holdings within those technical leaders indexes next quarter. So thank you everybody for joining us this week. If there's anything that we can do to help you in your business, please don't hesitate to reach out to us. Our email, dwa@dorseywright.com. Phone number, you can reach us at 804-320-8511. Thank you again. Look forward to talking to you next week.